Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is June 21st, 2025. Hey, I hope you're doing well. I hope you had a good trading week. I hope you're enjoying your weekend, and I certainly appreciate you coming to my weekend review podcast. I think I have some good things that we're going to go over today, and hopefully, you're going to learn a lot. And so the format for the podcast is, first of all, we're going to run the U.S. legal disclaimer as always. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I have, all the trades that I entered, all the trades that I exited. We're going to talk about when I entered the trade, why I entered the trade, what the confluence, what the combination of signals were, what the big picture of the charts were, and why I ultimately decided to enter the trade. We're going to talk about how I position size correctly based upon my account size and the volatility. We're going to talk about where I place my emergency stop, where I place my end of day stop, where I place my trailing stop level if the market starts moving in my direction, how I also take partial profits if the market starts moving in my direction, and then ultimately how I am going to exit the trade. So we'll talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage these trades going forward and how I did overall with my wins and my losses. After that, we are going to talk a little bit about trader psychology. I've been trading for over 30 years, everyone, and every additional day that I trade, and I mention this on the podcast all the time, but the more I am convinced and the more I am convinced that the only way to be a long-term profitable trader is you have to have a good trading plan. It doesn't have to be the best, really. You just have to have a decent trading plan that incorporates good trading principles. And then most importantly, you have to follow the plan. I deal with traders all over the world, and I follow their trades, and sometimes they'll have wonderful trades. And I say, why? Man, what a great trade. And they're like, yeah, well, I'm not really in that trade anymore. I'm like, why? Well, I thought that usually starts with I thought. And oh my gosh, they would have made so much money if they would have stayed in the trade and just follow the process. Or I look at the other side and I see a trade that goes down, and I'm like, well, good thing you got out there at your stop. Yeah, well, I thought that. As soon as I hear I thought, well, they didn't get out. So that's the problem, right? So I like to talk about trader psychology because, like I said, the most important skill in trading is the ability to create a plan. Creating plans is not difficult, but following the plan can be very difficult. So I hope it's helpful when I do these trader psychology sessions, because it's helpful for me to teach, and I hope it's helpful for you to hear and to implement in your trading as well. After that, I did go down through my master watch list last night. I go down through my entire watch list, both on the daily time frames and the weekly time frames, and I look for potential setups for the upcoming week. Confluences, combinations of levels, indicators, signals that are, possibly likely to get to where they need to get to take the trade for next week. And I like to do this on the weekend or on Friday night. The market's closed, everything's calm, everything's quiet, and I look at a chart and say, if this particular chart were to get there, you may have a deep dip buy, you may have an order block, you may have a double bottom bullish divergence. So one of the greatest advantages we have as small retail traders is we can look at a chart and say, okay, here is Apple, for example. If it went down 2 or 3% more, it would be running into these major levels of support, and that would be an ideal place to get into the trade. And large financial institutions, they can't do this. They're always buying, they're always selling, but we can wait for that perfect area. And maybe it doesn't get there, and if it doesn't get there, we don't take the trade. But if it does get there and it meets all of our requirements, then that's a great place to potentially enter a trade. Doesn't mean that trade is going to be profitable even if it gets to that location, but it certainly improves your chances. So that's what I do on the weekends or on Friday night. I look down through the charts, both on the daily time frames, the weekly time frames, and if there's something close that has a possibility of next week getting to that level, I mark them up on my charts, and I look at these charts every single day, and I say, oh, this one, oh, it's getting close to that level. And that's how I trade, and I've traded for decades this way. So I hope this is going to be helpful for you to kind of get an idea of the trades that I'm looking at, the potential candidates that I have next week. All right, so that's the format. That's what we're going to do. And let's go ahead and run that U.S. legal disclaimer, get that out of the way, and then we'll get rolling.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, so let's get started. I have quite a few open positions, which is good because I have multiple open positions that I took with different trading strategies and different setups. I personally use about 7 different trading approaches, and you'll see a lot of times I combine trading approaches. Maybe there's a deep dip buy, maybe there's also a bullish order block, but I have some abandoned babies in here, some island reversals, things like that. So I think it's good for you to see the different trading approaches because, you know, for example, abandoned babies. Abandoned babies are great, but they don't always happen. Order blocks are great, but they don't always happen. And I was just teaching a student of mine the other night, and he goes, oh, you haven't had a lot of return to value V1s, V2s lately. And I said, yeah, that's right. Because just the market has not been in that pattern yet. Doesn't mean I'm not going to use them in the future, but sometimes you get a lot more of a certain type of strategy than you do at others. But then in the future, maybe those kind of strategies will come around, and you'll start to have those as well. So here is the first position, the first trade that we're going to go through is UUP. I'm going to spend a little more time on this one. I like to kind of get detailed on everything that I'm doing with the trade on the first one, and then as we go through the additional trades, I won't be as detailed, but the first one I kind of like to set up. So here is UUP. UUP is the US dollar. I don't trade UUP a lot. I did enter the dollar here on the 16th of June at 27.17. So first question, why did I enter this trade? No, I guess I should say the very first thing I should go over is when I enter, how many shares do I buy? Really, most important thing, right? As soon as you decide you're going to enter a trade, well, how many shares are you going to buy? Right? And I do this by using 2 things. 1, how much is in my trading account, and 2, what is the current volatility of the market? And I do this on every single trade, regardless of the strategy that I use. So the first thing I need to know is how much money do I have in my trading account? Let's just say I have $100,000 in my trading account. I take 1% of that $100,000, which is $1,000. If it was $200,000, it'd be 1%, it'd be 2,000, right? Million, 10,000, 50,000, 500. So let's just use 100,000. 1% is 1,000. Then I look over here at the value of the 2ATR. The 2ATR is 2 times the average true range. The average true range is how much a market would be expected to move in any one day based upon the last 20 days. So this is when I talk about adjusting for volatility, adjusting your position size for volatility, this is what I'm talking about. I'm talking about taking your maximum allowed loss, divide it by 2 times the average true range. Because if the average true range has been very large, this number will will be larger. If volatility has been higher, this number will be larger, and therefore the amount of shares I'm going to buy will be smaller, and vice versa. So 1% of my total capital, let's say I have $100,000, 1%, that's 1,000, divided by the 2 ATR, divided by 0.31. That tells me to buy 3,225.8 shares. I'm just going to round that up to 3,226 shares, so I have an even number. So I entered here, and I'll get into why I entered, but I entered here 27.17. Now the first thing I do once I enter, and I just did the math, right? I took 1% of my capital divided by 31 cents. First thing I do when I enter is I take my entry price minus that 31 cents. And that is down here. Now that becomes my emergency stop, everyone. If I have 3,226 shares and it moves down to my emergency stop, 31 cents, how much have I lost? I've lost $1,000, right? Because I just did the math. And this is a very important thing, is when you get into a trade, knowing what your maximum allowed loss is going to be. Now the good news is this maximum allowed loss only happens about 5% of the time. The other 95% of the time, if you take a loss, it's going to be because of your end of day stop, not your emergency stop, because I always use 2 stops. But it's nice to be able to get into a trade, use the math, position size, knowing what the volatility is, and knowing, okay, in the worst case scenario, I'm going to lose $1,000. But again, knowing that it's very unlikely that I'm going to lose 1,000. 95% of the time, I'm going to lose less than that. All right, so we have to look at potential losses first. So that's how I position size, and that's how I place my emergency stop, regardless of the strategy that I'm using. So, okay, let's get back over now to why I actually entered the trade here. So there's a lot of combinations and signals going on here, actually on multiple time frames. And to really improve your trading results, you have to have confluences of signals. You know, I studied one-on-one with Dr. Alexander Elder, and he told me, he said, you know, Greg, it's very difficult to extract money out of the market using just one signal. It could be done, but it's a lot easier if you can use multiple signals, multiple confluences, multiple time frames to do this. And this is, you know, when I'm looking for trades, this is exactly what I'm looking for. You know, I teach private one-on-one lessons. I teach students all over the world, and I was just having this discussion last night with one of my students from Indonesia, Andre, and I said, listen, we have to look for the confluences of signals. And he goes, well, can you take a signal if there's just one? I said, you can, but your chances of having a profitable trade go up dramatically if you're patient and you wait for multiple signals. And there's a lot of multiple signals on this trade, and that's obviously why I took it. So again, I took it here on the 16th of June at 27.17. So first thing I'm going to highlight is this this blue box right here. This blue box is what is called an order block, a bullish order block. And you hear me talk about these order blocks. I use them every single day. I teach them, and they are very, very strong. Now you see this green box. What is this? Well, this is also an order block, but on a higher time frame. You see how I have a bullish order block on a shorter time frame within a bullish order block on a longer time frame? There you go. That's one of the confluences of the signal. So let me first highlight, why is this a bullish order block? Well, for a bullish order block, what you need is you need a swing low. Here, over here, back for 11.25, we have a swing low, followed by a swing high, followed by another swing low that is lower than the first swing low, and then the market moves up and takes out that first swing high. So we have swing low, swing high, lower swing low, market structure change. Once you have market structure change, and you're changed from a bearish structure to a bullish structure, now I can identify my bullish order block. And where is that? It's simply the lowest bar close before market structure change. So it's the here we go. Here's the lowest bar close, the high and the low. You can see the high and the low is where I made the blue box and I ran it out into time. So once you have a market structure change, I don't buy the market structure change, but I buy the pullback to the order block after the market structure change has happened. And that's very often where you will get a bounce. And so on the day that I bought it, the reason I bought it here, why? Well, because we rejected the high of the blue order block. You can see 3 days earlier, or 2 days earlier, we also rejected the high of the order block. Was that a valid signal? It was, but I didn't take it. I took it on a day when there were more signals. So to start off, we rejected the high of this blue order block on the day that I bought it. In addition to that, we also rejected the negative third Keltner channel right here. You see how during the day we went under it and then we went over it? So that's an additional signal. If we go to the weekly, I was talking about the larger order block. This is a weekly chart. Look, here's the green box. Why? Because we have a low, we have a swing low, we have a swing high, we have a lower swing low, we have a market structure change. So therefore on the weekly, this high and the low of this bar here, going all the way back to 2023, is the high and the low of the weekly order block in green. So you can see that I ran that out into the future, and that's why when we look at it on the daily chart, we have the green and the blue. The green is the weekly, the blue is the daily. On the day that I bought it, not only did we reject the high of the daily order block, but we also rejected the high of the longer term weekly order block, right? In addition to that, we had a V1. If you'd like to learn more about V1s, V2s, they're very good entry signals. In a V1, it consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So now I have a rejection of the daily order block, I have a rejection of the weekly order block, I have a rejection of the negative third ATR channel, and I have a V1. All right, so that is why I took the trade. I showed you how I position size, placed the emergency stop 2 ATRs below. Now I have to look at my other stop, my end of bar stop, the closer stop. Well, the end of bar stop is simply a close below the low of this daily order block, the blue box. You see the red line here? If I were to close below here, that's my stop, my end of bar stop. And you see how it's a lot closer than the emergency stop. All right, so rejection of the high of the daily order block, rejection of the high of the weekly order block. I entered 27.17, position size correctly, emergency stop 2 ATRs below, end of our stop, a close below the low of the daily order block. The next thing I do once I enter is I take my entry price, I look at the value of the 1.5 ATR, and I place that above my entry price. This is this orange line. Once I get to this orange line, then I go into what is called trailing stop mode. And this is just a way to tighten up my stop. You know, you hear about, hey, if a trade you have starts moving in the direction that you want, you need to tighten up the stop. Well, that's exactly what this is. And so you can see the price is not to the trailing stop level, but if it gets there, then all that means is that I'm in trailing stop mode. And what that means is now in the future, if I have a close below a previous bar's low, I will exit half of the position. All right. So everything I've talked about so far, as far as position sizing correctly, emergency stop, end of bar stop, trailing stop mode, these are all rules based upon defensive moves, meaning that if the market goes against me, I'm going to take action, defensive action. But just like any great sports team, you need to play offense and defense. And the way that I also play offense in my trading, and the way that I play offense in my trading is that I take partial profits each day if it moves a certain amount from the previous bar's close. And I'll show you exactly how I do that right now, because I am in this trade, it's doing well, and I'm starting to take partial profits if the trade moves my way. But let me show you how I'm going to set this up for Monday. I do this every day. I change this every day. All I do is I take the closing price. Right now the closing price is $27.40. I take $27.40 and then I look for the value of the 0.45 ATR. Right now the value of the 0.45 ATR is 7 cents. So I take the closing price plus 7 cents. My first profit target for Monday is $27.47. So I'll just put here $27.47. That is my first profit target for Monday. It's right here, $27.47. But I do this 3 times. So the first profit target, $27.47, and then I add the 0.45 to it again, plus 7 cents, plus 0.07. My second profit target for Monday is $27.54. And then my third profit target, I do it one more time. I take my second profit target, $27.54, plus 7 cents. My third profit target is $27.61. So I always place 3 profit targets in the system as a limit order. Now the question is, well, if it gets to 1 profit target or 2 profit target or 3 profit target, how much do I take off? It's very simple. I take 10% off of however many shares I go into the day with at each profit target. So if I go into this, if I'm going into Monday with, say, 1,000 shares, I identify my 3 profit targets, $27.47, $27.54, $27.61, and I place a limit order for 10% at each profit target. If I go into the day with 1,000 shares, 100 here, 100 here, and 100 here. Now, if this goes down on Monday, obviously I don't hit any profit targets. And then I have to redo my profit targets for the next day. But if it goes up nicely, decently, and I hit 1 profit target, great. I take off 10% of the remaining shares that I have. And if that's all I hit, that's fine. It's amazing how much money over time you will make by hitting these partial profits. And the other advantage is that you are starting to reduce your position size, which psychologically is good, because as you hit more profit targets and more profit targets, you have fewer shares and fewer shares, and you have fewer shares as it's going up, which is not a bad idea, right? So you're locking in things as it's going up, but it helps psychologically as you're taking these off. It helps psychologically to continue to follow your process correctly. All right. So anyway, that's basically the setup. I entered on the 16th at 27.17. Again, just real quick recap, rejected the high of the daily order block, rejected the high of the weekly order block, rejected the negative third ATR channel, plus you have a V1. I position size correctly, place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the daily order block. I placed my 1.5 ATR trailing stop level above. You can see the very next day took off nicely, hit multiple profit targets, right? So I'm already starting to take some off because I hit multiple profit targets in this day. Can't remember, I hit 2 for sure. I may have hit 3. Next day it went up, but not enough for a profit target. And Friday, it was down a little. So this is a really good example of using multiple signals on multiple time frames, looking for those confluences. And UUP at the moment, not doing too bad. You know, it's up 0.84% for a currency like the dollar. That's quite a lot. So so far on UUP, doing pretty well, up 0.84%. All right, let's go to Amazon. And again, going forward, I won't be as detailed on these as I was on UUP. Amazon. All right, I've been in this short on Amazon for quite a long time, down a little bit on the trade, but you can see over here in this red box. This red box is what's called a bearish abandoned baby. I'm sorry, a bearish island reversal. And, kind of a strange name. What makes this a bearish island reversal? Well, you can see on this day, on the 9th, we gapped up, big time gapped up. Then we kind of moved sideways. We didn't do anything for a few days, and then we gapped down. This is a bearish signal. You can see in this particular case, it's higher than where I entered the trade. But the point here is that if you have a bearish abandoned baby, if you have a bullish abandoned baby, if you have a bearish island reversal, a bullish island reversal, more times than not, when you have these patterns and you look in the future, there will be higher or lower. This one is a bearish island reversal. So more times in the future, when you look in the future, it will be lower. So the reason I took this trade here is because we formed the bearish island reversal. The day that I got short here, 205.90. Why did I get short here? Well, we came up to the bottom of that abandoned baby, rejected it, and closed below. And so this is where I got short. Now, when I trade abandoned babies, when I trade island reversals, I structure this trade a little bit differently, a little bit more simplistically than I do all of my others. And it's pretty simple. What I do is when I have an abandoned baby island reversal, I position size, as I showed you before. I place, because I'm short, I place a 2 ATR stop above. That's my emergency stop. But I place a 4 ATR profit target below. Again, when these signals happen, more times than not in the future, it's going to go in the direction that I'm placing the trade in. So if I'm right, I want to make more than if I'm wrong. So I got short here. I placed a 2 ATR emergency stop up here. I placed a 4 ATR profit target below here. I put them in the system, good till canceled. Obviously, in the future, one of these two are going to hit. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs, right? But if you go into the trade knowing that you have a mathematical edge that more times than not you're going to make your 4 ATRs, then lose your 2 ATRs, well, that's the reason I take the trade, because statistically I know more times than not I'm going to make twice as much as what I'm going to lose. But there are times where I am going to lose that 2 ATR. You can see I got pretty close, but then Amazon came back down on Friday. So I am currently down on this short position here, down 1.94%. But again, going into the future, I'm either going to lose 2 or I'm going to make 4. So that's Amazon. Let's go to UNG. Okay, UNG, you see a green box here, so that indicates that we have an order block. So why did I have an order block? Well, it starts here with this swing low here on the 16th. We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change, defining this here as my order block. Here, the high and the low of this lowest bar. I run that out into the future, and if it does come back to that order block or that smart money area, is what I like to say. And the reason I say this is, look, if you look here, this huge rally we had here, if you look in the past, this order block, would you agree that probably smart money was buying in this area? At the time, you don't know it, but in hindsight, you can look back and go, oh yeah, there probably was smart money buying there. So that means that now in the future, if it gets back down to that smart money area, I maybe want to think about buying again. And that's exactly what happened. And so we broke structure to the upside here, but I waited until we came back down to the bullish order block. And I got long here at 15 66 because it rejected the high of the order block. So I got long, I position sized correctly, I placed my emergency stop 2 ATRs below, my end of bar stops, they closed below the low of the order block here, 1504. I placed my 1.5 ATR trailing stop level above, and then of course, if the market moves my way, I'm going to start taking partial profits. The next day after I bought, bam, all the way up. I hit 3 profit targets, really nice. I also got to trailing stop mode, which means now in the future, if I have a close below previous bar's low, I'm going to get out of half. That happened here on the 22nd of May. You can see we had a close below a previous bar's low after reaching trailing stop level. I sold half of the remaining shares that I had at that moment, right? Because I'm taking partial profits every day as well. So that's the amount of shares that I have left. And I locked in a gain of 6.01%. And then we moved up a little, here, then we came back down, we came right back down to where I entered, right back down to the smart money area, bounced again, took partial profits here, then we moved sideways, then we moved down, we got down again close, and that's where we bounced again, took profits here, 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 and currently the remaining shares that I have on UNG doing nicely, up 11.38%. And again, this all comes down to buying in that smart money area that I just described, or in other words, a bullish order block. So the remaining shares up 11.38%. VIX. Next on deck is VIX. Okay. So why did I buy VIX? Well, this is, again, there is a confluence here. When I show you why, initially, why did I buy? Well, I bought here on the 12th of June at $51.25. Well, the main signal that I had was a simple deep dip buy. A close under the 200, close over the 200. The black line is the 200, right? And when it closed above the 200, it gave me a very, very good risk to reward ratio, because my end of bar stop, if I buy over a 200-day moving average, is simply a close below the 200. So it's very close to it. So the next day, had it closed 1 penny below, I simply would have been out. Okay, so the main entry signal was the close under, close over the 200. But as far as confluences goes, we have to look a little closer. And we have to incorporate the MACD. In what we have here, in addition to the close under the 200 and over the 200, is we have a bullish MACD divergence. Let me explain. We have this big move down here with very deep MACD bars. MACD is an indicator of momentum. So we had a lot of selling momentum, obviously, but you can see the actual reading for MACD very, very deep. After the move down, we had a rally up, and then in this area, the day before I entered, we are lower here clearly than we are lower here. But look at the MACD bars. Even though we're lower, they're barely visible. This is showing that even though we've moved down, we are not moving down at the same rate from a MACD perspective as over here. So in other words, you're running out of selling momentum. In other words, you're running out of sellers. And the implication is, if you're running out of sellers, there's a better chance than not that you're going to start to move up. Because if you run out of sellers, really the only place that has to go is up. If you run out of buyers, the only place that has to go is down. Okay, so this is how I viewed this trade. Okay, yes, we have a close under, close over the 200 with a very good risk to reward ratio. But in addition to that, from a MACD perspective, we're making lower lows, and MACD is not making lower lows. So I know that we have a bullish MACD divergence, which is bullish. So that is the confluence, everyone, right? And I use these divergences, not only MACD divergences, but I use ATR divergences. I use RSI divergences, and I've been using this for years and years and years, and this is also what I teach my students, right, is how to put these all together. So this has turned out to be a really nice trade so far. So I entered here at 51.25. I position sized correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 200. The next day takes off like a rocket ship. And remember my partial profits? I can't remember how many I hit here, but I have a feeling that I hit 4 profit targets on this day. It was 3 or 4. So literally I took off 30 or 40% of my position into this big up move. And not only did I hit multiple profit targets on this big up move, I also got to trailing stop level, which means what now? It means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Well, boom. Very next day, we closed below the previous bar's low after reaching trailing stop level. What did I have to do? I had to take off half of my position, ironically, at break even, right where I got into the trade. But remember now, I already took off, I can't remember now, I hit 3 or 4 profit targets on this day, but I've locked that in, right? The market can't take that away from me. The next day, we have another big up, hit multiple profit targets again. And so let's see what the remaining is. So the remaining shares on this particular trade doing well, up 4.13%, but really up more than that because of taking the partial profits when the market gave them to me, right? So not bad, up 4.13%. End of bar stop is a close below the 200-day moving average. BRKB. All right. I have been waiting for this particular setup for a long time. And if you've been watching my channel, you have heard me talk about this for weeks. And this is a good example, everyone, of stocking a stock, identifying the level where you want to buy it, and not buying it unless it gets down there. I have been talking for weeks. If BRKB, which is Berkshire Hathaway, Warren Buffett's company, if we got down to the 200-day moving average, that's where I wanted to buy. I was talking about it up here. It's like, I don't know if it's going to get there, but if it does get there, I'm going to get in. Very likely. Why? Well, because we have a confluence. We have an order block, a very wide order block, mind you. And then why is this an order block? Well, over here we have a swing low, we have a swing high, we have a lower swing low. We take out the first swing high, making the lowest bar close the order block. But this is a very wide order block, not a good risk to reward ratio. But my favorite trade of all time favorite trades, everyone, is when you have a major moving average, a deep dip by moving average, like a 200, a 250, a 300 that lives inside of the order block. And so I took the trade here on the 18th of June. Why? Because we bounced at the 200-day moving average. I entered 485.14. I position size. I placed my emergency stop 2 ATRs below. That's the red line. My end of bar stop is a close below the 200-day moving average. And then the orange line up here again is what? That's my trailing stop level. Have not got there. So trade hasn't done much yet. I mean, it's basically break even at the moment, but I know exactly what I'm going to do in this trade regardless of what the market does. If it moves up, I'm going to take partial profits. If it gets to trailing stop level, great. I'm going into trailing stop mode. If it closes below the 200-day moving average, I simply out with my end of bar stop. If it goes crashing down and gets to my trailing stop or my emergency stop level, what do? I simply get out of the trade, right? And I know how much I've lost. So it's important that you have everything set up in advance because you cannot control the market, but it's important that you know exactly what you're going to do regardless of whether it goes up, sideways, whatever, right? Again, back to your plan. It's very, very important. And you know, this I teach private one-on-one lessons. I teach people all over the world. I teach them all 7 of my different trading approaches. And this is what I teach each one of my students is how to use all these trading approaches, the setup, the psychology behind it. So if you are interested in becoming one of my students, I would love to have you as a student. I'll teach you everything that I know. I'm actually completely booked up at the moment, but in the future, when there's availability, I'll let you know. But the first thing, just send me an email and we can start a conversation that way. But I'd love to have you as a student. And like I said, I will teach you everything that I know. So this particular stock basically completely break even at the moment, but a good example, everyone, of waiting, identifying the level that you want to buy it at and not doing anything until it gets there. One other thing I want to show you here too is when you're looking at buying a major moving average, look in the past and see if that was respected. Well, look, if we go back here in the past, back into April, was the 200-day moving average, the black line, respected? Perfectly, to the penny almost. Does it mean it's going to be respected this time? Not necessarily, but if it was respected in the past, I would go out on a limb and say it's more likely to be respected the next time it gets there, although we don't know for sure, right? But we're just looking at probabilities, we're looking at degrees. So nice setup, bounce at the 200-day moving average, which is a deep dip buy, but combine that with the bullish order block here as well. In addition to that, I guess I should point out, negative third ATR channel, we are in that area as well. So this trade, very, very, I'm just going to call it break even because it's within a penny, but we'll see. We'll see for next week. MasterCard. All right. MasterCard is an entry that I bought on Friday. Have not seen this entry for a long time. This is 100% just a deep dip buy, but it's a confluence of deep dip buy. Here's the 200-day moving average. Here is the black line. Again, was it respected last time? Yeah, it was right here. But what's interesting about this particular trade is that it had one of the strongest setups that you can have as far as a deep dip back goes. You can see we had an intraday rejection of the 200, meaning we went below the 200 during the day and closed back above. That's clear, but look at the RSI. The RSI is 31.27. It was lower during the day. So essentially what you have here is you have an under 30, an intraday under 30, over 30. At the same time, you have an intraday under 200, over 200. You know, Steve Burns is a friend of mine, great trader, great author, and I spoke to him a couple weeks ago, and we were talking about the importance of the confluence on the deep dip buys of going under 200, over 200, under 30, over 30, and it's exactly what MasterCard MA did. It went under 200, over 200, under 30, over 30. Now, does this mean it's going to go racing back up? No, it doesn't, but it offers a good confluence. It offers a good risk to reward ratio. So I got in here 532.95, essentially right where it's at. I position size correctly. I placed my emergency stop 2 ATRs under. Where's my end of our stop? Just as close below the 200. You see how close it is to the 200-day moving average? So Monday, if this closes 2, 3 cents, 4 cents, 10 cents, 60 cents below, fine. It didn't work, but I got into a position where more times than not it's going to work with, and I'm limiting the amount of risk I have because my risk to reward ratio is so good. Placed my emergency stop 1.5 ATRs above. So I'm actually going to share this chart. When I'm done with podcasting, I'm going to share this chart with Steve because we were just talking about this. But perfect example of confluence of signals, strong confluence of signals with a very, very good risk to reward ratio if I am wrong. All right. So those are all the current open trades. McDonald's is the last daily trade I'm going to show you. Now, this one didn't work out, but again, it's a good learning moment and good teaching moment. I got long McDonald's back here on 6/11 at 301.61. Why? Confluence of signals that didn't work out. Intraday rejection of the 200-day moving average, intraday rejection of the negative third ATR channel, plus a V1. I got long at 301.61. I placed my emergency stop 2 ATRs below. My end of bar stops have closed below the 200. My 1.5 ATR trailing stop level is 1.5 ATRs above my entry. What happened? Next day, okay, didn't do much, went up a little bit. Next day, went up enough for me to hit one profit target, which in hindsight, I'm very grateful. And then what happened here? On the 16th of June, I had to get out because it closed below the end of bar stop, which is the 200-day moving average. You can see my emergency stops down here. So yes, I took a loss on this trade of %1.77%. But the point I'm trying to make here is, what about if I had not respected my rules and not got out of the trade here? Now look at it. And if you're supposed to get out here and you don't get out here and now it's down here, what do? It's a tough spot. Do you get out here finally and just call it good? Or in your mind you're thinking, well, it's pretty low. I think it probably could rally and I would, get out if we have a rally. Maybe it does. Maybe it keeps going down. But it's a tough position to be in. It's better to just take your loss, follow your rules, take the first loss. The first loss is the easiest, right? So yeah, loss on this trade of 1.77, but again, a good teaching moment of, if you don't get out of your trade, what are you going to do here? You're down at some other levels. I get that, but I'm glad I got out. Glad I got out when I did. All right. So just a review of the daily trades. UUP up 0.84%. The Amazon short down 1.94%. The UNG trade up 11.38%. VIX up 4.13%. Berkshire literally break even. MasterCard literally break even. And McDonald's down 1.77%. So the reason that I just showed you all those percentages, I'm trying to make a point. In trading, it is okay, obviously, to have a large win, right? And I had some large wins on UNG for sure, and on VIX, right? So having large wins are great. Having small wins is fine, like UUP, right? Is fine. Having small losses or break-even trades is fine. BRKB, MasterCard. Having small losses is okay, like Amazon and McDonald's. But what you cannot have, or what you should really try to avoid, are large losses. And if you see what I showed you, we had some big trades, we had some small winners, we had some break-even trades, and we had some small losers. But you don't see any big losses there because of how I structure and set everything up. And so I suggest that you look into doing that for yourself. But just, I could say it a million times, stay away from large trades. How do you stay away from, okay, Greg, I like to stay away from large trades. How do you do that? Position size correctly and have your emergency stop. For me, I use the 2 ATR. Okay, so those are the daily trades. Let's go over to the weekly trades now. Now, weekly trades expire, or I'm sorry, the bar closes on a Friday, so I make all my buying and selling decisions on a Friday. Here is QQQ. I shorted QQQ here a couple weeks back at 529.92. Why? Well, we have you can see the red box here. This is a bearish order block. We have a swing high, followed by a swing low, followed by a higher swing high, followed by the price going through the first swing low, or in other words, changing market structure from bullish to bearish. And if you change from bullish to bearish, then if you get back into that bearish order block, that's where I am looking for a short. The reason I shorted here on the 6th of June was because, one, we are in the bearish order block, just simply that, and two, we rejected, you see the thick red bar here, this is halfway of this bar on the 21st, the big down bar. If you have a big down bar and you rally to halfway of that big down bar, you have some inherent resistance there. So not only are we at the halfway of this big down bar having the inherent resistance, we're also in the bearish order block. So I got short here at 529.92. I placed my emergency stop, of course, 2 ATRs above, but the question is, where is my end of bar stop? Well, I'm always talking about keeping a very tight stop level. It's right here. It's this red bar. It's 533. So I got short at 592.92 or 529.92. So a stop of 533 is pretty close, isn't it? Right? So the very next week, you can see during the week it was above my stop, but it closed below, keeping me in the trade. This week again, it was above my stop, but it closed below. So far, I've picked that end of bar stop pretty well. So this particular trade at the moment is profitable. Not a lot, but 0.62% on the weekly Q trade. And now let's go to Nike. Nike is a deep dip buy on the weekly. This one's worked out quite well. I got long Nike back here in April on the 18th. Why? Confluence of signals. One, deep dip buy. We went under 30 during the week, closed back above 30 at the end of the week. That was the main signal. In addition to that, here's the negative third ATR channel. We went below the negative third ATR channel during the week, closed back above. So that is the confluence. So I entered, placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level, obviously 1.5 ATRs above. My end bar stop is simply a close below the 30 RSI. Next week, moved up, hit some profit targets. Next week, didn't do much. No profit targets. Next week, didn't do much. No profit targets. Next week, moved up nicely. I hit multiple profit targets, and I also got 2 trailing stop level. Next week, we had our first close below the previous bar's low. After reaching trailing stop level, I locked in a gain of 7.2%. The next week, we were up a little, hit a profit target. Next week, up again, hit a profit target. Next week, up again, hit another profit target right at the highs. And now we were down this week. But the remaining shares doing quite nice on this particular trade, up 6.62%. I do want to point out that it shows here earnings are coming out next week, 6/26. I never hold through earnings. So regardless of where the price is, whether it's lower or higher, I will exit and finish this trade before earnings come out because I never hold through earnings. But Nike, remaining shares up 6.62%. And then last but not least, TLT. Seems like I've been in this trade for about 19 years. But really, I got in on 117.25 at the beginning of the year. Why? Well, we have a green order block here. I got in at 87.20 when we rejected the negative third ATR channel and we rejected the high of the order block. Position size, placed my emergency stop 2 ATRs below. My end of bar stops, it closed below the low of the order block. I placed my trailing stop level 1.5 ATRs above. Next week, moved up, I hit a profit target. Next week, moved up again, I hit a profit target. Next week here, moved up very nicely, hit another profit target, had a couple weeks of sideways motion, and then this week here had a big move up where I hit multiple profit targets. So I'm taking off partial profits, locking in those gains on the way up here. And then on this particular week, other than in addition to multiple profit targets, I also got to trailing stop level, which means now I have to get out of half if I have a close below previous bar's low. Moved sideways for a month, had a profit target here, had multiple profit targets here, thankfully, because then we had the big down bar where I have a close below a previous bar's low after reaching trailing stop level. So I had to get out here for a loss, for a loss of 0.59%. But am I really down 0.59%? No, I'm up on the trade. because I took the partial profits, right? So then we move sideways the next week. Next week again, more partial profits. Next week again, more partial profits. Then we had straight down for a month. Really glad I took those profits when I had them up here, right? And now for the last month, we've kind of been moving up. So the remaining shares that I have are slightly down on TLT, 0.86%, which slightly down trades are okay. But listen, all in all on this trade, I'm up on this trade. And again, it is because of the taking the partial profits when I had them. So just to recap on the weeklies here, Qs, the short up 0.62, Nike, the long up 6.62%, and the TLT trade down 0.86%. But again, it goes back. Is it okay to have a big gain like Nike? Yes. Is it okay to have a small gain like the short on Qs? Yes. Is it okay to have a small loss on TLT? Yes. So I'm just trying to show you through the positions that I try to keep my trades in those acceptable areas. All right. So those are all the particular trades and the current trades that I had for this week. And let's go, and before we take a look at potential trades for next week, let's take a look and talk a little bit about trader psychology. Okay, this is from Tony Stark. Tony always posts really great sayings about trading. And when I read this, I was like, yep, I'm definitely going to talk on the podcast about this today. Approaching the market as a humble trader will help prevent you from becoming a humbled trader. This is from Peter Robbins. Peter Robbins featured in one of the Market Wizards books. And Peter Robbins is a great trader and has a lot of knowledge. And when he says something, I think we should probably take it to heart. And I can attest to you, everybody, because I went through this in my trading journey. Listen, I started trading in my 20s after I sold my chewing gum company. And I was very young, a lot of testosterone, a lot of money, but I did not have a lot of experience and I didn't know what I was doing. And I had huge losses when I first started. And I was not humble at all. I thought I knew what I was doing. Nope. And I became humbled. But because I became humbled, it was my lifelong journey to work with as many different traders and authors and really learn how to trade. And I did that over 30 years. And that's what I'm teaching you right here and right now is everything I've learned, right? So you don't have to go through the school of hard knocks, everybody. I know traders that are not humble and they get humbled all the time. The best traders in the world are the ones that are scared, the ones that are humbled, or that are humble and say, I don't know if this is going to work. I'll take the trade, but I don't think it's going to work. That's the right mindset to have. I learned that from Larry Williams. He said, Greg, I go into every trade assuming that I am going to lose. And I do that for ego reasons. If I take the trade and I think it's going to lose and it loses, I go, aha, I was right. And it's easy to get out. But if you go into a trade going, oh man, this one's going to the moon for sure, and it doesn't, now you have a conflict between your ego and what the market's doing. And if it goes down, closes below your stop, you may not get out, right? So I know this sounds negative, but it's not negative. It's a reverse negative. Go into each trade very humbly, thinking, well, this may not work out. And if it doesn't work out, then it's easier for you to get out of the trade. But please, you don't have to become humbled, everyone. Be humble. Look at every single trade as one of the next 1,000 trades, but be very open to the idea that this trade is going to be a losing trade. And if it is, okay, fine. Go ahead and get out. You're going to have many winning trades in the future. But go be humble. If you're cocky, if you're egotistic, if you think you know everything, good luck to you, because very likely you will be humbled. So it's pretty simple, but it's very, very accurate. Hope that was helpful for you. All right, everybody, let's get on to some serious business here, and let's take a look at the potential trades for next week. So I always start off by saying, when looking at these potential trades, look, here, these are the daily trades, and I'll get to the weekly. These are the daily trades. I have 8 potential setups here. Theoretically, all 8 could trigger on Monday. Will I take all 8 trades? Absolutely not. I only take the best trade of the day. I don't care if there's 50 that have signaled and are legitimate. I am going to narrow those 50 down to 1. Here is 8. Again, they could all trigger on Monday. I'm going to narrow it down to the best one. How do I do that? I look at multiple things. How many entry signals are there? How many confluences are there? How does it look on a higher time frame? What's the relative strength of this market compared to the rest of the market? What's the risk to reward ratio? It's very important. I like the idea of just taking the best one every day. Doesn't mean that one is going to have to work, but I know I picked the best candidate going into the day. And this is what I teach all of my students, how to do this, how to narrow down and weed out many entry signals to the best one. And again, if you'd like to become my student, I would love to have you. I will teach you everything I know. I am totally full at the moment, but if you'd like to get on the waiting list for some openings in the future, just send me an email. We'll have a nice little conversation online. I like to meet all of my potential students online first. We talk about their trading goals, their trading challenges. It's a good time for them to ask me questions about the course and the format of the course. It's not a sales call, everybody. I promise you that. It's not a sales call. I literally just like to put the face with the name and see if we're a good fit. So my email is in the link of this YouTube video. Just send me an email and we can schedule our first call. And like I said, it's not a sales call. It's just to kind of get to know you call. And then in the future, when some slots open up, we can get started. So anyway, write me. Love to be able to talk to you. So let's start here with AGQ. AGQ, I had a great trade on AGQ a while back. And actually, one of my students had a fantastic trade on AGQ. This is back here. Stephen from New York entered here at $40.21. Why? Simple deep dip buy. Rejection of the 200-day moving average. He got out up here. So congratulations on that trade, Stephen. So what I'm looking at now, though, you see I have the 2 bars here in the red. What is that? We talked about it earlier in the podcast. This is what is called a bearish island reversal. We have a gap up followed by a gap down. 77% of the time with this particular structure and this particular pattern, you are going to be lower when this happens. You're up, followed very quickly followed by down. So if I had to guess, not guess, but just when I look at the statistics of this, very likely this will be down further than up further in the future. So does this mean that I took this trade? Well, no, I didn't take the trade yet. Technically, it's valid to take it here. But what I'm looking for, when I look for island reversals and a band of babies, I like them to form. And then I like to see kind of that knee-jerk reaction move up. And what I'm looking for is a move up and a rejection of the bottom of this bar, the bottom of the bearish island reversal. So next week, if I get a rejection of 48.90, and what I mean by rejection, that we go up here, try to go up and then fail below it, that would likely be my entry point for the short. And again, with an island reversal or a band and baby, if this happens and I get short, I'll place a 2 ATR stop above, a 4 ATR profit target, and I'll just let it go. One of the two are going to hit, but the odds are on my side to hit my 4 ATR profit target instead of the 2 ATR stop because of this pattern. So again, on AGQ, I'm looking for a rally up and a rejection of the low of the order, or the low of the island reversal here at 48.93. Alibaba, BABA. All right, this is a good example of a really nice setup that I don't know if it's going to get there, right? But if it does get there, then it's met the requirements. Here we have a bullish order block. The high and the low of this bar here. The high is 107.21, the low is 96.14. So it's a wide order block. But this is the smart money area if we come back into this green box. But you can see inside the green box what lives in the green box. The 200-day moving average, the 250-day moving average. These are legitimate signals all by themselves. These are deep dip buy signals, but they're better than just simply deep dip buy signals because they are in the smart money area. My favorite setup of all times, everybody, is a rejection of the 200, a rejection of the 250, a rejection of the 300 or the 30 RSI deep dip buys if they live in a bullish order block. And by the way, I forgot to mention, I have a great course available at udemy.com that simply, it's 9.5 hours, but we learn the deep dip buy approach. I've been talking about the deep dip buy approach a lot today, the 200, the 250, the 300, the 30 RSI. So I have sold so many of those courses around the world. It's on udemy.com. It's a great site, respectable site. The cost is somewhere between $30 and $50 for that course, but the link's in the description. Go take that course. You are going to get 9.5 hours of really good instruction, really good rules, and a really good stock trading strategy that you can use for the rest of your life. And like I said, the link's in the description. So, but again, here again, we have deep dip buys. Clearly, we have deep dip buys coming into view, 200, 250, but it is these deep dip buy moving averages are inside the bullish order block. So what am I looking for? I am looking for next week. I don't know if it's going to happen, but if it does happen, I would certainly consider taking a trade. Next week, if we go down for whatever reason, we intraday reject that 200-day moving average or bounce or close under, close over, I would certainly consider getting along there. If it goes lower, I can do the same thing at the 250-day, some kind of rejection of the 250 days. So that's what I'm looking for. That's confluences. BITO, which is Bitcoin. Okay, we are inside of a bullish order block. Again, why? Swing low, swing high, followed by a lower swing low, followed by a market structure change. If you change market structure and then you come back down into the order block, that is the area that I want to look to buy. So I have two potentials here at the moment. My ideal potential is that we go down and reject the low of this order block. The low of the order block is 2037. So we go underneath it during the day and then close back up in it. That would be a legitimate entry. And in addition to that, it would give me a very, very good risk to reward ratio. The other option is if it moves up, a close above the 200-day moving average or a close above the high of the order block. Either way, on that approach, I would use the 200 as my stop because it's a closer stop. So ideally, going forward, it goes down underneath the bullish order block, closes back in, which would be a valid signal, and then I have my end of bar stop very, very close. Or if it goes up, closes above the 200, that's valid as well. Then I'd use the 200 as the stop. DIA, Dow Jones Industrial. Okay, another bullish order block. What makes it a bullish order block? Swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change, defining the high and the low of the order block as 418.17, the low 413.83. That is the green box that I have drawn here. Three options. First option, we come down, we reject the high of the order block. That's an option. It's my least favorite option because the risk to reward is not as good, but it is legitimate. Because remember, in the order block here, if you're using an order block, the low of the order block is the stop. So one option, rejection of the high of the order block. The second option, which I really like, is here at 415.60. Why this? Well, look, over here on the 23rd, we have this big up bar. If you have a big up bar and you come to halfway of that big up bar, you're going to have inherent support. And in addition to having inherent support, it gives me a very defined line in the sand. So if we were to come down, reject that during the day, close back above it, then it's rejected the halfway of this big up bar, which one is good, and two, it gives me a very well-defined stop. Very good risk to reward. Third option is if we come down, reject the bottom of the order block, close back in. Of course, that's a good signal as well, and it gives you, again, a very good order block. So 3 options on DIA. If it comes down, if it doesn't, what are we talking about? Not going to do anything, but if it does, reject the high of the order block, that's one option. Number 2, reject 415.60 is the second option. Third, reject the low of the order block there at 413.83. Johnson & Johnson, J&J. Okay, well, Johnson & Johnson had a big move up. Now it's having a big move down. Well, here we go. Here's your bullish order block. Again, why? Swing low, swing high, lower swing low, market structure change, smart money area down here. 3 options here. Rejection of the high of the order block at 147.56, my least favorite option because the risk to reward's the worst. Second option, rejection of 146.10, which is halfway of the V2 here, and it gives me a good risk to reward ratio and a good line in the sand. Third option, rejection of the low of the order block at 144.87. MasterCard, I don't know why I have this in here. MasterCard's the trade I already took. Pfizer, nice little bullish order block here. The high and the low of the order block is 23.44. The low of the order block is 23.18. It's a pretty narrow order block. So the option here is if we come down, reject the high of the order block at 23.44 or reject the low of the order block at 23.08. Don't know if it's going to get there, but we've had a nice move on Pfizer, having a pullback, which is not unheard of and very likely. But buying this pullback would make sense, but you have to have the structure. Rejection of the high of that order block would be fine. I like this better than the other ones that I was looking at because it's more narrow, so the risk to reward. So we'll see what happens with that. But yeah, rejection of the high of the order block at 24.09 or rejection of the low of the order block at, the high of the order block at 23.44, the low of the order block at 23.08. And then last but not least is the SPY, S&P 500. You can see up here, everyone, that I drew the bearish order blocks, and I had the line here, 605. That was halfway of a big down move, which would have inherent resistance. Look, the market got there exactly to the penny of that level that I was looking at, and we've moved back down from there. So those order blocks, no joke. Really, those order blocks, no joke. Here, I'll show you bigger picture here, hopefully. Yeah. Big down bar here. As I was saying, if you have a big down bar and you get back to halfway of that, that's going to be the resistance, 605, and the 605 lived inside of the bullish order block, or the bearish order block, and the market got there to the penny. Unbelievable. But going forward, we have a bullish order block below. The order block here, the high is 581.81. The low is 575.60. But inside the order block, what is there living? Deep dip buy, 200-day moving average. That would be really good entry with a very good risk to reward ratio. That's what I'm looking for. Okay, those are the dailies. Let's go to the weeklies, and then we will be done for the day. Interestingly, I have my 40th high school reunion tonight. Can you believe that? I can't believe it's been 40 years since I have been in high school. Wow. It's going to be interesting to go, see how people are, see what they're up to, see how they look, right? So, yep, I'm doing that tonight. Okay, advanced micro devices. we have a pretty wide bullish order block. And again, why is it the order block? Swing low, swing high, lower, swing low, market structure change. Now I need a pullback. I'm not going to chase it here, but now I need a pullback. What I'm really looking for, about the only thing that I'm looking for on AMD, is a pullback to the 300 week moving average. The 300 week moving average is at $100.88. It's very unlikely that we're going to go down there, but if it does, that's the spot that I want to buy it at. I'm not going to chase it up here. I am waiting for it to get to where I want it to get, right? And that's the 300 week moving average inside of bullish order block. It's the only thing that makes sense. So if it gets there, I'll consider taking it. IWM, Russell 2000. Okay, this one, more likely that we could get there. We are in a wide or bullish order block, and the 200 week moving average lives inside that order block. The 200 week is at 198.36. We're currently at 209.20. Could it get there? It certainly could. Is it likely? I don't know. Probably not likely. Probably like a 20% chance, something like that. But again, this is the level that I want to get involved at. A major moving average inside a bullish order block. So if it gets down and rejects 198.36, I'll consider taking it. McDonald's. Okay, so I had a losing trade on McDonald's this week, but on the dailies, but there's a beautiful area down here to potentially get long McDonald's on the weekly. We have a beautiful order block down here. The high is 282.11, the low is 273.39. But we have the 100 week moving average that's inside of the order block. I don't use the 100 a lot, but look, it's a moving average, it's a level. It gives me a good risk to reward ratio. It's at 279.90. We're at 287.46. Can it go that far? It certainly could. It certainly could get there. So I would look on McDonald's here for either two things. One, clearly, ideally, a rejection of 279.90, which is a rejection of the 100-week moving average inside the bullish order block, or the other would be a rejection of the high of the order block, 282.23. That's only $5 away. It could certainly do that. If I took either of those trades, I would still use the 100-week moving average as my stop. Even if I took the rejection of the high of the order block, I'm not going to let it go all the way down to the low of the order block in this case, because that moving average is there. So rejection basically of, what did I say there? About 282, the high of the order block I could get long, or rejection of the 100-week moving average at 279.90, and that would be my end of our stop right there. Morgan Stanley. Okay, looking for a bearish short trade on this. We have a bearish order block. We have rallied. You can see we got right to the bottom of the order block, and that's right where the market stalled out at. But ideally, what I'm looking for is a rejection of 135.10. It's just a couple dollars away. It's the same trade as I had on the Q short. So next week, if we rally up, reject the high of that, or reject the high of 135.10 and then close back below. Look, it's a rejection of the big bar down inside a bearish order block, and it gives me a very good risk to reward ratio. If I take that and the next week it closes above, I'm out. That's it. So a lot of bearish confluences here. Tesla, talked about Tesla for quite a long time. It just hasn't got to where I want it to get to. We have a bullish order block here. The high is 284.99. The low is 236. Again, why? Because we have a swing low, we have a swing high, we have a lower swing low, we have market structure change. So I'm waiting for a pullback into the smart money area. What I'm really looking for, and I've been talking about this for weeks, is here. 200-week moving average inside the bullish order block makes a lot of sense. In addition to that, we have a big up bar here on the 25th. Halfway down, you're going to find inherent support that all nestles all together here. 200-week moving average, 253.41. This one here, 256. It's just right in this area. I'm just going to call it rejection of the 200-week moving average. That would be a perfect setup Doesn't mean it would work, but it would be a perfect setup with a very good risk to reward ratio. And last but not least, everybody, is XLV. I have talked about XLV for weeks. We just have not got to where we need to get to. There's a beautiful order block on the weekly down here. There's a 300-week moving average running inside of it. That is what I'm looking for. You can see here on the 16th of May, look where we got down to and bounced. The high of the order block. Healthcare was down last week. So now that we're going down, we could certainly get there. But I would love to get long XLV in the next couple weeks if we move down and reject the 300-week moving average inside that order block. Gives me a good structure, gives me a good risk to reward ratio, and gives me multiple levels to key off of. And that 300-day moving average is 126.90. We're currently 132.60, so it could certainly get there, and I would be watching that trade very carefully. So listen, I hope this was helpful, everyone. If it was, I would appreciate if you could hit the thumbs up button. Really helps out the channel, lets YouTube know there's some valuable content here. Hey, if you haven't subscribed, please subscribe. That would be great as well. If you'd like to become one of my students, the one-on-one, I teach a great course, everybody. I changed the course up a little bit. 10 different sessions, 2 hours per session. It's 20 hours of one-on-one with me. It's great because we learn all the different trading approaches, and we see each other every week. So we're following the markets, we're seeing the changes in the markets and how to adjust and how to do that. So like I said, I'm completely booked up at the moment, but love to talk to you, get you scheduled in the future. But my email is in the link in the description. Send me an email. I hope you have a great rest of your weekend, everybody. I'm kind of excited to go to my high school reunion tonight and just see what it's going to be like. It's going to be interesting. I will let you know. But I always like to leave off with, please try to go out and do something nice for someone every day. If we all did one nice thing every day, the world really would be a better place. If you have it in your heart to go out and try to do one nice thing for an animal every day, that would be great as well. That would make the world a better place all in all as well, and it doesn't take much, right? So, God willing, I will see you next week. Enjoy the rest of your weekend. Get yourself a trading plan. Follow that trading plan. And also, by the way, if you have any questions about anything that I went over today, please let me know, and I'll do my best to get back to you. Thank you so much, everyone. Enjoy your weekend. Hopefully see you next week. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.